In 2011, a man walked into a tax office in Houston, Texas, handed over a stack of documents, and filed a completely legal tax return. A few weeks later, the IRS sent him a check for $2,300,000. No lawyers, no court, no scandal. He just asked for it, and they paid. His name was Calvin Moret. He wasn't a Wall Street banker. He wasn't a lobbyist with connections in Washington. He was a former accountant for a mid-sized logistics company in Texas who'd been laid off during the 2008 financial crisis and spent the next 3 years reading the U.S. tax code the way most people read a thriller novel, looking for the twist, and he found it. Not one twist, several. Today, we're going to walk through exactly what he did, step by step. Because here's the thing, nothing Calvin did was secret. Nothing was hidden. Every single move he made was described in publicly available IRS publications. The instructions were there, in plain English, on the government's own website. The question isn't how he found the loophole. The question is why no one told you it existed. Let's start from the beginning. The United States tax code is 74,000 pages long. Let that number sit for a second. 74,000 pages. The entire Lord of the Rings trilogy, all 3 books combined, is about 1,500 pages. The U.S. tax code is 50 times longer. And here's the part that doesn't get talked about enough. It wasn't designed to be understood. Not by you, anyway. When most people think about taxes, they think about one thing. How much do I owe? They get their W-2, they plug the numbers into TurboTax, they pay whatever it says, and move on. Maybe they get a small refund. Maybe they owe a little extra. Either way, the game feels fixed. The number comes out of a machine, and you just pay it. What Calvin understood, and what took him 3 years of reading to fully grasp, is that the tax code isn't a single calculation. It's a negotiation. And like any negotiation, it heavily favors the person who knows the rules better than the other side. The code is full of provisions that were written specifically to benefit certain groups: real estate investors, corporations, agricultural businesses, energy companies. These provisions aren't loopholes in the sneaky sense. They're not back doors or glitches. They're front doors. They're written right there in the law. But they're written in language so dense, so referential, so buried in subsections and cross-references that the average person filing their taxes every April has no idea they exist. Calvin lost his job in October 2008. By January 2009, he was doing what a lot of accountants do when they suddenly have a lot of free time. He was reading. Not tax preparation guides, not how to save money on your taxes blog posts. The actual code. Title 26 of the United States Code, starting from page 1. He told a financial journalist in 2014, in the only interview he ever gave, that the first 6 months were mostly confusion. The code references itself constantly. Section A tells you to look at Section C. Section C tells you to refer back to Section B, subsection 4, paragraph 2. You spend more time navigating than reading. But around month 7, something shifted. He started seeing patterns. And the patterns started looking less like bureaucratic noise and more like a deliberate architecture, a system within a system, built not to keep money out of people's hands, but to keep it available if you knew how to ask. The first pattern he noticed had to do with something called basis. If you've ever bought stock, you've probably heard this word. Basis, in tax terms, is essentially what you paid for something. If you buy a share of Apple for $100 and sell it for $150, your gain is $50. Your basis was $100. Simple. But here's where it gets interesting. The tax code doesn't just apply basis to stocks, it applies it to almost any asset, property, intellectual property, business interests, and critically, debt. Debt has basis. When Calvin read that for the first time, he had to read it again, then again, because on the surface that seems strange. Debt is money you owe. How can money you owe have a value that reduces your tax bill? The answer goes back to something called at-risk rules, written into the code in 1976 after Congress got tired of wealthy investors using partnership losses to erase their entire taxable income. The rules were designed to limit how much loss you could claim based on how much you actually had at risk. If you invested $10,000 of your own money, you could only claim up to $10,000 in losses. But the rules created an exception, and the exception was for debt. Specifically, certain kinds of debt you personally guarantee count toward your at-risk amount, which means they count toward how much loss you can claim, which means if you structure it correctly, borrowed money can generate tax deductions that exceed the amount you ever actually spent. Calvin read this and immediately thought of something he'd seen at his old company. A specific type of transaction that happened occasionally, usually involving real estate or equipment financing. The company would borrow money, use it to buy an asset, take depreciation deductions on the asset for years, and eventually sell or write off the asset, generating a loss that reduced taxable income significantly. Nothing illegal, nothing unusual. Standard corporate tax planning. But Calvin wasn't a corporation. He was an unemployed individual with a laptop and a lot of time. He started asking a different question, not, can a corporation do this? But, does anything in the code say an individual can't? He spent 4 months looking for the answer, and the answer, as far as he could tell, was no. If you want to drop a comment below telling me what you think so far, go ahead, because it's about to get a lot more interesting. Here's what Calvin decided to do. He was going to build a structure, not a business in the traditional sense, not a company with employees or offices or products. A structure, a series of legally connected entities, each one created specifically to interact with the tax code in a precise way. Step 1 was forming a limited partnership. A limited partnership has 2 kinds of partners. A general partner, who manages the partnership and has unlimited liability, and limited partners, who invest money and share in profits or losses but aren't personally responsible for the partnership's debts. With one exception. That exception, if a limited partner personally guarantees a debt of the partnership, that guaranteed debt counts toward their at-risk basis. Calvin formed the partnership with himself as both the general partner, through a small LLC he created for $300, and as a limited partner. He owned 99% of the partnership as the limited partner. The LLC owned 1% as the general partner. This is called a self-settled structure. It's not exotic. Tax attorneys set these up every week for real estate investors and business owners across the country. Then came step 2. Calvin borrowed money, not from a bank, from a private lender, a retired financial professional he'd found through a professional network, a man who was comfortable making structured loans to small investment vehicles. Calvin borrowed $2.8 million at a fixed interest rate, personally guaranteed the entire amount, and used the funds to purchase a portfolio of distressed commercial real estate notes, essentially loans that other people had defaulted on, sold off at a fraction of their face value. The purchase price, $2.3 million. The stated face value of the notes, $9.1 million. The gap between those two numbers is where everything happened. Under IRS rules, specifically the rules governing market discount bonds and distressed debt instruments, when you purchase debt at a significant discount, the difference between what you paid and the face value isn't automatically income. It becomes income only when and if you collect on it. Until then, it sits on your books as potential, unrealized, untaxed, waiting. But the depreciation, the interest payments, the operating losses of the partnership, those were real. Those were happening now. Those were deductible now. And because Calvin had personally guaranteed the $2.8 million loan, his at-risk basis in the partnership was $2.8 million, which meant someone who knew Calvin told someone who worked at a small tax boutique in Dallas. That person told a partner. The partner called Calvin. By early 2013, Calvin was working informally with 3 tax attorneys and 2 CPAs who had clients, real clients, with significant income and significant tax bills, who were interested in what he'd built, not copies, variations, each one tailored to a specific client situation, specific assets, specific income history, the at-risk rules, the guaranteed debt basis, the carryback mechanism. These were the bones. But the flesh was different every time. One client was a physician who owned a stake in a medical practice and had 12 years of W-2 income on the books. Another was a commercial real estate developer in Arizona who had overpaid taxes during a period of high income before a market downturn wiped out much of his portfolio. A third was the owner of a regional trucking company who had sold a division of his business at a significant gain and was looking at a tax bill that would have required him to liquidate assets he had spent 20 years building. In each case, the structure was built around the same core principle that Calvin had identified. Personally, guaranteed debt creates basis. Basis creates the capacity for loss. Loss, properly documented and properly applied, reduces taxable income, retroactively, through the carryback mechanism, reaching back into years when significant taxes had already been paid. The refunds in these 3 cases totaled a little over $6 million combined. All 3 were reviewed by the IRS. All 3 were paid. Now here's where it gets complicated. And this is the part that most people, even people in the tax world, don't fully appreciate. The IRS isn't one thing. It's a bureaucracy with hundreds of thousands of employees, multiple divisions, and a set of competing institutional incentives that don't always point in the same direction. The division that processes individual returns is different from the division that audits them. The division that audits them is different from the division that writes policy. The division that writes policy is different from the Office of Chief Counsel, which is the part of the IRS that actually litigates cases in tax court. When Calvin's first refund was processed, it was handled by an examiner in the Individual Returns Division. That examiner consulted with a supervisor, brought in a consultant, and made a determination. That determination, pay the claim, was documented internally. But the documentation didn't automatically flow to the policy division. It didn't automatically flag the chief counsel's office. It sat in a file. By the time the third refund, the trucking company owner's $2.4 million check, was processed and paid, someone in the policy division had started to notice a pattern. Not because of Calvin specifically, because of the distressed debt market generally. After the 2008 financial crisis, the market for distressed debt, defaulted loans, non-performing mortgages, underwater commercial paper, had exploded. Billions of dollars of bad debt were being sold off by banks at steep discounts, and a significant number of buyers were using structures that looked in various ways similar to what Calvin had built. Some of those structures were being used by hedge funds, some by private equity, some by smaller operators who had learned the strategy from consultants or attorneys, or in a few cases from people who had heard about what Calvin had done. The IRS Policy Division opened a review, not of Calvin, of the category. They were trying to figure out whether these distressed debt structures, as a class of transaction, were generating losses that Congress had actually intended the code to allow, or whether they were producing results that were technically legal but practically inconsistent with what the law was designed to do. This is a real distinction in tax law. It's called the economic substance doctrine, and it matters more than almost anything else in this story. The economic substance doctrine is one of the most powerful tools the IRS has, and one of the most controversial. The basic idea is this: a transaction has to have genuine economic substance, not just legal form. If you structure a deal purely to generate tax benefits, with no real business purpose and no real economic risk, the IRS can disregard it, even if every step was technically legal. The doctrine was codified into law in 2010 as part of the Healthcare and Education Reconciliation Act, a piece of legislation most people remember for entirely different reasons. Section 7710 of the tax code now formally defines economic substance and attaches strict penalties to transactions that lack it. Calvin's first filing was in 2011, 1 year after the codification. Here's the thing about Calvin's structure, though. It had economic substance, real economic substance. He actually borrowed real money. He actually purchased real assets, distressed debt instruments with real face values, from real counterparties at prices that reflected real market conditions. He actually personally guaranteed a real loan. If the distressed notes he purchased had continued to perform at zero, if he'd never collected a dollar from them, he would have lost the spread between his net proceeds and his outstanding obligations. He had real risk, real assets, a real business purpose. He was trying to recover value from distressed debt, a legitimate investment activity that thousands of entities engage in every year. The economic substance argument didn't stick, but the policy review did something else. It produced a memo, an internal guidance document circulated within the IRS suggesting that future examiners pay closer attention to individual filers using guaranteed debt structures to generate large carryback claims. That memo didn't change the law. It didn't close. Calvin said he expected it. He said any time someone finds a way through a system like that, the system adjusts, not necessarily to close the door, just to make sure it's harder to find. The journalist asked him if he felt like he'd done something wrong. Calvin paused for a long time before answering. He said, "I followed every rule. I documented everything. I gave them exactly what they asked for and more. I didn't hide anything. I didn't lie about anything. I built something real, took real risk, and claimed what the law said I could claim. Then he said something that I think about every time I look at a tax form. He said, "The question isn't whether I did something wrong. The question is whether the system that paid me is the same system that tells everyone else they're getting a fair deal." And if the answer to that is yes, then everyone should be reading the same 74,000 pages I did. The journalist asked if he thought most people would. Calvin said no, because reading it takes time, and time in this country is the one resource that money has always been able to buy more of. The interview ended there. Calvin Moret has not spoken publicly since. The tax code is still 74,000 pages long. The at-risk rules are still in it. The loss carryback mechanism still exists, with some modifications passed in 2021. The distressed debt market is still active. And somewhere right now there is almost certainly someone sitting at a kitchen table reading a document that was never supposed to make sense to them, looking for the same thing Calvin found: a door.